Negative cash flow condos. Many people misunderstand this completely and think if you're negative cash flow, you do not make money. In this video, I'm going to show you how it actually works and that you actually do make money. Hi, my name is Vas and I'm a chartered professional accountant turned realtor that's built and invested in real estate right here in Toronto, York region, and in secondary market. Now, for privacy reasons, I'm going to use a personal condo that I bought last year, summer of 2021. I have many examples like this for clients of my own that have purchased and have also made money and continue to make money with their quote-unquote negative cash flow condos. Now let's take a look at this example here. So this was a listing that was, I would call it not done well. As you can see, it was listed at 620, then at 550. I ended up buying it for 500. There's a bunch of factors of how this whole thing came about. But as an agent, this is effectively what I'm looking for. I'm looking for listings that are not done well, or I can effectively swoop in and hopefully get it at a good price. So this is kind of what happened here. I bought it for $500,000 and then I rented it out for $1,980. So we're working with actual numbers. These are all factual. We're not hypothesizing anything here. So this is the condo. It's downtown Bay and Dundas. Solid condo, very popular with healthcare workers that work along University Avenue. This is something that I like when I am looking for rental properties. Anything along Bay, actually, I really like. Now, getting into the model. If you look here, let's start with some of our assumptions. So $500,000 is the purchase price. I put 20% down. I have a mortgage of $400,000 on it. The interest rate at the time when I got it, which was variable, was 1.7. It's gone up since. The payment has remained the same. It's just I'm getting less principal paid down. My interest expense is a little bit higher. Again, these things will fluctuate, so we have to keep in mind that we're not trying to be ultra precise over the 10-year period that I plan on holding this, if not longer. We're just trying to get a benchmark and a baseline because I use this model to compare different properties between themselves at a point in time when I'm shopping. So that's the interest rate, purchasing fee, so this is your land transfer tax. Cost of capital we're not going to get into in this example, but we're going to keep it static. Again, just keep this number static as you're doing these comparables. My maintenance fees are at $311. They're going to increase at about 3.5%. Occupancy, I feel I'm not going to have much in the way of occupancy. I've put the average rate here of 95%. Property tax is $142. My rent is $1,980. This is a COVID rent. I believe the rent is already higher, but this is what the tenant is currently paying right now. And I've put in the rental growth rate that we're allowed to increase the rent by as per the government guideline. Now, insurance, $20. Miscellaneous expenses, $40. This is the most important part of this entire video. This is where majority of the confusion comes in. So in this table right here, what we're looking at is my negative cash flow. So I'm negative, I have to supplement roughly just over $200 a month to keep this condo. So meaning my rental income is X. These are all of my expenses. They add up to $25,000. So I'm out $2,600 a year, and therefore I'm negative cash flow $218. And this is why people think I'm not actually making money. Well, how are you making money if you're spending over $200 a month to own this and your rent doesn't cover all of your expenses? Well, this is very simple. This is what is misunderstood between most people. They think that interest plus principal, so your entire mortgage payment, is an actual expense, when in reality, it is just the interest portion that is the actual expense. So in this case, my total mortgage payment for the year is, call it $20,000. But realistically, it's only $6,800 that's interest. So that means the remainder is effectively forced savings. That is me paying down my principal payment. So if I don't make money in terms of I don't have cash in my pocket, but this is all going towards the equity of the home. So it is forced savings. So that means in effect, I'm actually making money. I just don't have access to it, but I will have access to it when I sell the place. This is why it's very important to understand that when we're looking at negative cash flow condos, we're looking at the IRR rate, which is the internal rate of return for a specific project. So I don't care that I'm out $218. I do care about how much interest I'm paying. So in my case, it's $6,800 and everything else is technically profit because it's the rent money plus the $200 I'm putting in that's actually paying down my principal. Now let's see how this plays out in the actual model. So as you can see here, in our model on line 22, we're only taking into account the interest rate not the principal. Based on that, that makes this particular purchase, it has an IRR rate of 13.84%. Therefore, I'm making, call it, almost 14% on this. And this is with some very conservative assumptions. Now, the biggest and most conservative assumption I've made here is that my price appreciation on this condo is 3.5%. Keep in mind, this doesn't take into account that I probably bought this place at $40,000 to $50,000 to $60,000 below market. So in effect, there's $60,000 of forced value that could be in here, that should be in here, that's not even reflected in here. So my appreciation, it's 3.5% based off of this price. If I want to get more aggressive, I could put this possibly at 5 or even higher to reflect that I already have forced appreciation in this condo. And assuming the real estate market stays stable, 3 to 5% for a condo downtown in a very sought after area is reasonable. And with that assumption, that brings our IRR rate at 16%. Now again, things have changed. It is now 2022. The market's going through a bit of a softening, but condos are still performing really well. They are appreciating, rents are also increasing, and there is the unwind of COVID, meaning people are moving back into the core because they don't want to commute and their employers want them to actually come into the office. But this is to show that just because you're out a few $100s a month doesn't mean you're not actually making money. It just means you have to supplement the payment. You're effectively taking money from one bank account and putting it into your mortgage account. That's all you're doing. So it's just from one pocket to the other, but the money is yours and you're still making money. I hope this clears it up. If you have any more questions or you would like a copy of this model, comment below. If there's enough interest, I'll post the link to where to download it. And if you want further explanation or if anything wasn't clear, let me know. Thank you, and I hope you found this helpful.